Good afternoon, everyone. Welcome to the meeting, the press conference after the MPC, and allow me to introduce our newest member to the MPC. On my extreme right, that's not necessarily his views, is Kuban Naidu. He has joined the bank as advisor to the governor and the member of both the MPC and the Financial Stability Committee. So this has been his first meeting, and welcome. And thank you all for joining us here today. The South African economy is facing a number of domestic challenges, while headwinds from the fragile and uneven global recovery remains a constraint to growth. The uncertain and increasingly difficult labour relations environment continues to dominate the economic landscape, contributing to declining domestic and foreign investor confidence. The growing vulnerability of the economy to changes in sentiment has been reflected in the depreciating and volatile exchange rate, which was already under pressure from the widening deficit on the current account of the balance of payments. Although inflation is forecast to remain relatively contained, these factors have raised the upside risks to the outlook at a time of worsening real growth prospects. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas was 5.9% in April 2013, unchanged from the previous 2 months. However, the drivers of the overall rate changed somewhat. Food price inflation measured 6.3% in April, reversing the downward trend that had prevailed since November 2012. The contribution of food to overall inflation remained unchanged at 0.9 percentage points, while housing and utilities contributed 1.4 percentage points. Administered prices increased by 8.9% and by 7.8% excluding petrol. Core inflation, which excludes food, petrol and electricity, measured 5.2%, marginally up from the 5.1% in March. The headline producer price inflation for final manufactured goods measured 5.7% in March, up from 5.4% in February. The inflation forecast of the bank was relatively unchanged since the previous meeting of the MPC. Inflation is now expected to average 0.1 percentage points lower in 2013 and 2014 at 5.8% and 5.2% respectively, and to average 5% in 2015. A temporary breach of the upper end of the target range is still expected in the third quarter of 2013, but at a lower average level of 6.1% from 6.3% previously, followed by a gradual moderation of inflation to 4.9% in the final quarter of 2015. The slight improvement is due to changed assumptions about international commodity prices, including oil, and lower global inflation. The forecast for core inflation for 2013, at an average of 5.3%, is significantly higher than the forecast of 4.8% previously. This follows the sharp increase in medical insurance costs in the February CPI. Core inflation is also expected to be adversely affected over the coming months by increases in a number of other administered prices, particularly water and municipal rates and taxes. This measure is expected to peak at 5.4% in both the third and fourth quarter of 2013 and to average 5% and 4.6% in the coming 2 years. Despite the higher near-term trend, this indicator is still assessed to reflect an absence of significant demand pressures. Inflation expectations, as reflected in the Reuters survey of analysts conducted in April, has remained relatively stable for some months. The forecast is the same as the bank's for 2013, although higher for the next 2 years, but still within the target range. The relatively anchored inflation expectations at the upper end of the target range are also evident in the survey conducted by the Bureau for Economic Research in the first quarter of 2013. Overall, respondents expect inflation to average 6% in both 2013 and 2014 and 6.1% in 2015. The global economic environment remains challenging, with different regions growing at varying rates. Within the advanced economies, the United States appears to be showing a number of positive signs of recovery. The University of Michigan's Consumer Confidence Index is at its highest in almost 6 years. Labour market developments have been more favorable, and there are strong wealth effects from the booming equity market as well as from the recovering housing market. However, headwinds can be expected from the fiscal contraction resulting from the fiscal cliff compromise and the spending cuts that were part of the recent sequester. The impact of this contraction is expected to be as high as 2 percentage points of GDP. The Eurozone remains in recession, having contracted at an annualized rate of 0.9% in the first quarter of 2013, compared with a contraction of 2.7% in the previous quarter. The French economy has recorded two consecutive quarters of negative growth, while Germany managed to avoid recession by recording annualized growth of 0.3% in the first quarter of this year. The Eurozone is constrained by continued deleveraging by households, banks and governments, and the region is also characterized by increasing financial fragmentation. Although a slower pace of fiscal consolidation in the periphery has been agreed to in terms of the bailout agreements, negative or at best very low growth is expected to persist in the region for some time. The Japanese economy rebounded from its 2012 recession in the first quarter of 2013, but it is still too soon to assess the impact of the fiscal, monetary and structural policy stimulus packages that were announced recently. The yen exchange rate, which has depreciated by around 30% against the US dollar since October 2012, is likely to contribute positively to growth. Emerging markets remain the main global source of growth, but there are signs of moderation in some of the systemically important countries, particularly China, India and Brazil. The rebalancing of the Chinese economy away from fixed capital formation and production towards internal consumption has resulted in some slowdown, which has contributed to the declining trend of global commodity prices. The persistence of slow global growth and weaker commodity prices have resulted in a moderation in global inflation. This is particularly the case with respect to energy prices in the advanced economies. This combination of lower inflation and slow growth prompted further monetary easing by the ECB, and with Japan yet to begin its quantitative monetary easing, these accommodative policy stances are likely to persist for some time. While there are concerns about the possible risks posed to financial markets and global capital flows by an early reversal of the US monetary policy stance, any such action is likely to be extremely cautious and is only expected to begin once a sustained recovery is well entrenched. There are, however, growing concerns that the buoyant conditions in the financial markets in many countries are indicative of bubbles caused by excessive global liquidity, rather than reflecting underlying positive growth prospects. Movements in the exchange rate of the rand continue to be impacted by external developments, but since mid-2012 these have been compounded by domestic factors which have undermined investor sentiment. The increasingly fraught labour relations environment and high wage demands in the mining sector in particular are likely to continue to impact adversely on the volume of mining exports against a backdrop of falling international commodity prices and concerns about the widening of the current account deficit of the balance of payments. These developments also have the potential to affect, directly and indirectly, South Africa's credit ratings and increase the cost of much-needed finance. The rand has also been influenced in recent weeks by the hedging related to renewable energy projects, as well as a strengthening of the dollar. Since the previous meeting of the MPC, the rand has depreciated by around 4.6% against the US dollar and by 3.7% on a trade-weighted basis. Despite the current negative sentiment towards the rand, non-residents have remained net buyers of bonds and equities this year. Since January, non-residents have been net buyers of equities to the value of 12.7 billion rand and bonds to the value of 22.5 billion. However, these positive inflows can reverse very quickly in response to changing risk perceptions. Furthermore, any hedging of these exposures, as is sometimes the case during periods of rand weakness, puts pressure on the rand even though the underlying assets are still held by non-residents. As we have noted previously, the impact of the weaker rand on inflation is dependent on the extent, speed and duration of the depreciation, as well as the phase of the business cycle. While some of the recent decline reflects changes in underlying fundamentals, the rand remains highly vulnerable to changes in sentiment. The rand has a tendency to overshoot in either direction, and at times for extended but uncertain periods, making the impact on inflation difficult to forecast. The current level of the exchange rate, if sustained, poses a significant upside risk to the inflation outlook. Domestic growth prospects remain fragile amid low consumer confidence, continued output disruptions in the mining sector, electricity supply constraints, and a weak global environment. The growth forecast of the bank has been revised down from 2.7% to 2.4% for 2013 and from 3.7% to 3.5% in 2013 and 2014. Growth is expected to accelerate to 3.8% in 2015. At these growth rates, the negative output gap will widen further before stabilizing next year and begin to close during 2015. This outlook is consistent with the flat trajectory of the bank's leading indicator of economic activity. Notwithstanding the increase in the RMB-BR Business Confidence Index in the first quarter of 2013, given the difficult labor relations environment in the country and the risks to global growth, the downside risks to growth remain, as does the possibility of increased job losses. Although the physical volume of mining production recorded a quarter-to-quarter increase of 6.1% in the first quarter of 2013, following the disruptions in the previous quarter, output contracted on a month-to-month basis in both February and March. The outlook for the sector remains bleak, with threats of shaft closures and retrenchments, falling commodity prices, high wage demands, and a risk of protracted periods of industrial action and further supply disruptions. Manufacturing production declined in the first quarter of 2013 compared with the previous quarter, although the extent of the decline is complicated by the seasonal adjustments for the Easter weekend, which fell over March and April. The Kagiso PMI, which increased marginally above the neutral 50 level in April, reflects the uncertain outlook for the sector. The depreciated value of the rand should improve the competitiveness of the sector, provided that gains are not eroded by rising wages and prices. The weaker rand is expected to result in some narrowing of the trade deficit. However, the subdued global demand, together with robust import volume growth driven to a large extent by infrastructure projects, suggests that the net export position will remain negative over the forecast period and continue to be a constraint on growth. Nevertheless, the BR Manufacturing Confidence Index, while still low, improved somewhat in the first quarter. The outlook for household consumption expenditure, in recent years the main driver of growth, appears to have weakened, with the FNB-BR Consumer Confidence Index declining to a 9-year low in the first quarter of 2013. Retail sales grew at a modest quarter-to-quarter rate of 0.6% in the first quarter of this year, while sales contracted on a month-to-month basis in March. This was consistent with a decline in the BR Retail Confidence Index in the first quarter. New vehicle sales growth, while increasing significantly on a year-on-year basis, moderated to 0.1% on a 3-month-to-3-month basis in April. Consumption expenditure by households is expected to be constrained in part by lower real income growth, significant increases in the price of electricity and petrol, and high debt levels. The slowdown in expenditure growth has also been related to the moderation in some categories of credit extension by banks. Year-on-year growth in total loans and advances to the private sector moderated steadily from a recent peak of 10% in December to 8.1% in March 2013. Excluding the weak growth in mortgage advances, year-on-year growth in loans and advances declined from 18.5% in December 2012 to 14.5% in March. Although growth in unsecured lending to households remains at high levels, it has declined continuously since September 2012 to measure 27.9% in March. This moderating trend is expected to continue, due in part to the increasing number of impaired advances in this category of lending at some of the banks. However, the ratio of total impaired advances to total loans and advances in the banking sector continues to decline and stands at just below 4%. A number of sectors in the economy are entering into wage bargaining rounds. The MPC is increasingly concerned about the prospect of settlements well above inflation and productivity growth, and the risk of protracted and disruptive strike action, with negative implications for growth and exports. Furthermore, excessively high settlements will come at the expense of retention of employees, employment creation, and could result in higher inflation. The risk of a wage price spiral remains high. This would negate the benefit of wage increases to workers and undermine the competitive gains of the currency depreciation. According to Andrew Levy Employment Publications, the overall wage settlement rate in collective bargaining agreements increased from 7.6% in 2012 to 7.9% in the first quarter of 2013. Should this upward momentum continue, it is likely to impart an upside risk to inflation. At a time of high and rising unemployment and slowing growth, the imperative of an economy-wide commitment to wage and salary restraint at all levels, including executive pay, cannot be overemphasized. International oil prices are expected to remain constrained by the subdued global growth environment, but vulnerable to political developments in the Middle East in particular. Having reached a recent high of around $118 per barrel in mid-February of this year, Brent crude oil prices have remained in a range between $97 and $105 per barrel since April. The domestic price of petrol increased by 12 cents in April, but declined by 73 cents in May, mainly as a result of lower international oil prices. Although there is currently a small average over-recovery on the petrol price, recent exchange rate movements have raised the probability of further petrol price increases in the near term. The higher CPI food price increases in April may have reversed the favorable food price developments observed in recent months. Since the end of November 2012 to date, domestic maize prices have declined by about 17% and wheat prices by around 9%. This is reflected in the Producer Price Index for Agriculture, which increased at a year-on-year rate of 1.4% in February and declined by 0.2% in March. Manufactured food prices, by contrast, increased by 6.1% and 6.3% in the same months respectively, in line with CPI food price increases. The exchange rate poses an upside risk to food inflation as prices of agricultural commodities such as wheat and maize are based on international prices. The MPC is increasingly concerned about the deteriorating outlook for the South African economy. There are a number of critical domestic issues that are contributing to the vulnerability of the economy that need to be urgently addressed. These include the financing of the deficit on the current account of the balance of payments, the fractious labour relations environment and the associated risks of protracted work stoppages and excessive wage increases, electricity supply constraints, upside risks to inflation, downside risks to growth and employment creation in a context of high unemployment, and declining domestic and foreign investor confidence, which could impact directly on capital flows. These interrelated developments are reflected in the volatility and weakness in the exchange rate. There is an urgent imperative for all parties, government, business, labour and civil society, to interact and address these issues and vulnerabilities at a national level. While the Bank is prepared to play its part, many of these challenges are beyond the role, scope and effectiveness of monetary policy. While a depreciated exchange rate is part of the balance of payments adjustment mechanism, the competitive advantages thereof need to be realized through price and wage restraint. In the absence of such restraint, the outcome is simply higher inflation with the risk of an exchange rate inflation spiral. Given the current unsettled environment in the economy, the MPC assesses the risks to inflation to be on the upside, while many of the above factors contribute to a downside risk to growth. The MPC assesses the current stance of monetary policy to be accommodative. Given the risks outlined above, the scope for further monetary easing is limited at this stage. The MPC has therefore decided to leave the repo rate unchanged at 5% per annum. The MPC stands ready to act appropriately in either direction in the event of material changes in the outlook. Thank you. It's the end of the statement, and I can see many hands straight away. Please, colleagues, just remember that you will also be answering questions. So if we could perhaps start with you, Mariam.
Thank you, Governor. Are you concerned at the current level of the rand, and do you think that it is undervalued at present?
I think that question would be better able to be answered if we knew at what moment in time you were talking about in the day. Generally, because what we are seeing is the rand moves very significantly. And as we've said before, we do not target a level of the exchange rate. But as I've said, I think I have elaborated in the statement quite considerably that it depends how long it is out for, how long the depreciation lasts, what extent it is, what is the sustained levels, and what its impact would be in that regard. We're also saying that at these levels there is the question of using a depreciated currency to improve competitiveness and make sure that if there is a depreciation, it is maintained and not eroded by either inflation or either wage demands or price hikes. So I think we have spelt it out quite considerably in the statement. Renee.
Good afternoon, Governor. It's Renee Volgraaf from Sunday Times. Governor, I want to know, in the bank's improved inflation outlook, was the recent risks of the rand taken into account, and also the risks of possible above-inflation wage settlements that you referred to?
I'm going to ask my colleagues to respond. Who would like to take? Brian?
In the latest forecast round, we did assume some further depreciation of the exchange rate, not necessarily to the current levels, but we are cognizant of the risks to that. So a lot depends, as the Governor said, on whether it remains at these current levels or if it comes back. But there is a weaker exchange rate assumed, but clearly the fact that the outlook or the forecast didn't change very much means that it was offset by other factors, including lower commodity prices. But certainly we see the upside, the overall upside risk to the inflation outlook coming primarily from the possibility that the exchange rate could remain at these very depreciated levels.
France?
And the wage settlements.
Sorry, the wage settlements are the other main risk, that upside risk that we see to the inflation outlook. We are concerned about the level of the some of the wage, the first round of these wage demands that have been put forward. But as we know, they don't always turn out to be at those levels. These are simply the first round of the wage bargaining. But in addition, we know that in the past that wage increases are not necessarily automatically translated into price increases. That would depend on the pricing power at the time, and also depend to what extent employers simply focus on the wage bill, and therefore you see some reaction in terms of the amount of employment.
But I think just in addition to that, it's got to also reflect the levels of productivity. So it's not just the absolute levels of what you eventually settle at. It also can be, the level is not as important if you're getting the component of productivity that would then address some of the issues there. So it's not absolute levels only, it's also what happens with productivity. Frans?
Governor, Franz Wild from Bloomberg. You say the Rand has a tendency to overshoot. In this instance, just talking about this morning, for example, where it nearly reached 9.7 to the dollar, is it your assessment that it has overshot and will come back, or it's hard to tell?
I'm going to ask Daniel to deal with that, but don't forget also what you're dealing with at the moment is dollar strength. So it's not just a Rand factor, but Daniel?
Yeah, I think, as we've indicated in the statement, when there are changes to the fundamental backdrop, it is normal for the currency to adjust. The key concerns would only arise if those adjustments happen in a disorderly manner or very abrupt and in very sharp moves. And that is not just limited to the Rand. It happens with all free-floating currencies that as and when there's a change in the underlying fundamentals, to try and find a new level does tend to be associated with over and undershoots and all that. It's difficult to sort of pin them down to a particular level and say if the Rand this morning in reaction to the news overnight, be it out of the US or the issues associated with Chinese data that resulted in different risk perceptions, you can't sort of put it at a level, say at the level of whatever 969 or 68. That is actually then when the point of overshoot is reached or not. So it's difficult to pin it onto a particular level. So I couldn't tell you whether this morning was an overshoot.
Yes, sir.
Tsapamoy, SABC Radio News. If you put competitiveness aside, what in terms of wage settlements, what would be the dangerous level in terms of wage settlements that you as a Reserve Bank you'd be concerned about?
Well, it's not just competitiveness. I don't think you can put competitiveness aside if you're trying to compete in a global market. And productivity is also a factor. But we have a 3 to 6% inflation targeting band. So that should be a guide as to, and you look at the inflation expectations as we have set them out in terms of the BR survey. So that should give you an indication of what would be conducive in the South African economy.
I mean, anything above inflation? Because, I mean, wage settlements must be slightly higher above inflation to compensate for the losses because of inflation.
Well, that's one argument, but the question is, you used the word slightly. So the question is, I'm not commenting on particular wage demands at the moment. What we're saying is that it's got to be a factor, and don't forget, we weren't just talking about wages, we're also talking about prices. So that you've got to have the question of both an issue around ensuring that you don't have a wage price spiral that erodes the benefits and simply results in high inflation, and therefore you may have higher numbers, but you don't have a better income. Let me just see if there's anyone on the line, Yolanda.
Governor, a question from Gareth Brickman. Given the downside revisions to growth, did the MPC discuss a rate reduction? Thank you.
Yes, we did, extensively. And in answer to Mariam's unasked question, while in the end the decision was unanimous in terms of the agreement that the question of a rate reduction is an important discussion, and certainly one member of the MPC felt that it was necessary to reduce rates now. So it is certainly on the table, but as we've tried to outline in the statement, that we think there are many uncertainties, and a lot of the issues that are affected and would be affected are not necessarily within the scope of monetary policy, but it was certainly on the table.
You just answered my question.
Okay, so the unasked answered question. I don't know if any colleagues would like to add anything. Anyone else? You can't be so silent. Renee, your mic is on, so...
I don't know how to kill it, I'm sorry.
Oh, we don't want you to kill it. We'd just like you to switch it off. Okay. Somebody can help you. There is a button, and you press off.
No one else press the button.
As long as it's the right button. Anyone else? France, again?
2 quick questions. First one is, who thought it was better to reduce the rate? Second one, is now a good time to buy gold?
The first question obviously is not answered. We're giving you the flavor of the meeting. And who would like to address the question of gold? Dan?
Is also not answered because we don't,
we don't give
investment advice.
We can't give you investment advice.
No, but sorry, would it be is now a good time for the bank to buy gold, maybe?
That's a different question altogether, and perhaps that would deal with the question of our reserves.
Yeah, we have, as a bank, held an amount of around 4 million fine ounces in gold as part of our reserves holdings, and we, from time to time, assess whether that is the correct level of what we should be holding from a point of view of having a diversified basket of reserves. At this particular point in time, we seem quite comfortable with that level. The governor just indicated maybe to provide some comparison with regard to maybe what other central banks are holding in that regard. There has been discussions by a number of them who had indicated that they would like to buy some gold. In fact, a number of them have actually increased their gold reserves. But when you look at the proportion of what they're currently holding in gold vis-a-vis what we hold, we have already got a fairly significant proportion. So we have already got that diversification component in our reserves established, whereas some of these central banks would come off very low levels and are looking to get to levels of around 10, 12, 15% of holdings in gold, and we are already there.
Given the level the rand is at, and given your belief that greater stability would be in the rand would be beneficial, would the Reserve Bank consider intervening in terms of stabilizing the rand at any point?
Franz, you know that the value of the rand is determined by the forces of demand and supply in the foreign exchange market. The question that you are asking, would we intervene, by the way, was also asked when the rand was strong, and the answer has not changed. It is still the same. What we are not concerned about is not so much the level of the currency, but rather the rapid movement in the level of the currency. In other words, we are concerned about the volatility of the currency. As if you were interested, we had previously intervened in the foreign exchange market, and we came out second best. We did learn our lesson, and as it stands, you would know that we had previously would go into the market to cream off once-off big capital flows to smooth the movements in the currency and accumulate reserves. But I guess that's a long way of saying to you no.
Governor, a question from Peter Montalto. How much should we read into the term material at the end of the statement? That is, how big a hurdle is there to a cut, considering that one member is already thinking along these lines, especially given that now the market will probably aggressively start pricing in cuts from here after that answer? Thank you.
I think it would be premature for the markets to start pricing in a cut, as if that is an inevitability. We would weigh up the data. It depends on the circumstance. It depends on all the other issues that we've raised, in terms that we do say quite clearly is that we would be ready to intervene either direction, depending on what happens. So I think that's, you know, to get ahead, the market should not get ahead of itself. We are saying very clearly that there is a discussion about an interest rate cut, but that would be determined by the exact information that we have at the time of the next MPC meeting, or the meeting after that, or the meeting after that. It is not something that says, from here we've got an inevitable outcome in the next MPC. I think the markets would get ahead of themselves if they made that assumption from this discussion. So I would strongly advise that you don't do that, but take account of the fact that we are saying there are very difficult conditions, and that our challenges are both the question, and our core responsibility must remain the question of price stability. And we are seeing a question that the exchange rate depreciation has an impact on that. And obviously, as we've said, it depends how long the depreciation lasts, the speed of that, etc., and whether the currency retraces, as it has a tendency to do, and to what extent. So I would not want the market to get ahead of itself, but to be aware that we are aware of and taking account of what is happening in the economy as a whole, bearing in mind on the other side our responsibility for price stability. So I would say, Peter, I would advise you not to get too ahead of yourself. Several.
From the statement, it's clear that the bank is not concerned about the levels of unsecured loans. But would you be concerned about the exposure that banks have on unsecured loan?
Lesetja, do you want to address that? Or
I thought you said you are taking me off it today.
I was taking you off it today. Okay. I mean, I think you've got to look at unsecured loans in terms of the total picture on loans. And as we said in the statement, the question of impairments is just below 4% in the overall. There has been some moderation in what is being granted in unsecured loans. And clearly it's filling a gap of need, but must be more measured. Obviously, we are not complacent about it at all. We have met on a number of occasions from the Bank Supervision Department on an ongoing basis to look at all the banks and what their programs are in that regard. So I would say that it's not about, we're certainly not complacent about it, as we can see from the recent developments in the two banks that have dealt with or are the primary market for unsecured lending. But if you look at it, the four largest banks extend about just under 45% of the total unsecured retail lending, and that constitutes 1.8% of their gross credit exposures. So in the bigger scheme of things, in the total, it's small, but it does not mean that it is either insignificant or immaterial. So yes, it's something that Bank Supervision Department, under the very watchful eye of Deputy Governor Kanyako, continue to look at this matter. Let me see if there's a... Frans?
This is actually kind of a follow-up. In terms of looking at bad debts, especially in the unsecured lending space, is that an industry-wide problem, or is it related more to the likes of African Bank who focus on that?
Look, I think the question here, if one looked at it, first of all, our banks have remained very profitable. If you looked at their return on equity, it's increased from 14.6% in January of 2011 to 16.9% in March of this year. It's very adequately capitalized. Our total capital adequacy for our banks is just under 15% compared to the minimum ratio of 9.5%. Your two banks that deal with unsecured lending are capitalized far more than that. It was at 32%. So that, in terms of the capital adequacy, in terms of the approach taken by the banks in relation to unsecured lending, it's something that we watch very carefully because obviously it deals also with a vulnerable sector of your population. But I do think they are well capitalized, and certainly we're not complacent around it. If one had to look at your bad debts in that regard, I think that obviously they have a higher ratio in terms of their market, but it is then compensated for in terms of the capital adequacy. So I don't, I think that, as we've said, the ratio of impaired advances to gross loans is just under 4%. So I would say that it's something that, given the global climate, we watch very carefully throughout the banking sector. But we have not had the problems that typified the global banks, because they were characterized by high leverage, low capital adequacy ratios, low loss absorbency capital instruments, whereas our banks don't have any of those features. But certainly something that is the Bank Supervision Department, given this question that you've had a global systemic banking problem, obviously watches very carefully. And that is precisely part of the move to Twin Peaks, that you would look at an improved regulatory environment in terms of both market conduct and prudential. Renee?
Governor, back to your speech, I would like to know whether the committee is at all worried about the quality of inflows that finances our current account deficit. You refer to the fact that a lot of the inflows on bond and equities can reverse very quickly.
Well, at this particular stage, much as we've seen a little bit of a tapering off, in particular this month with regard to non-resident investment into the equity market, on both sides we continue to see net positive inflows. I think the risks that we're trying to point to in the statement has to do with the fact that, particularly with regard to this discussion that has dominated sort of market developments today around the possible timing of when in advanced economies unconventional monetary policy measures might start being scaled back, given the very high level of interest that not only in the South African markets but that we have seen international investors showing in emerging market securities. There could be that correction, and some of that could reverse. But at this particular point in time, in line with the flows that we're seeing to other emerging markets, South Africa is continuing to attract portfolio flows. As I say, much more on with regard to bond inflows as opposed to equity inflows, but positive on both sides. Some around 36 billion or so since the beginning of the year, combined.
Yeah.
Thank you. It is Mary Misa from Business Daily. I forgot to introduce myself last time. Governor, you spoke a lot about the wage issues and the risk that they pose to inflation and the economy, the labor strife, and so on. In your view, what needs to be done to tackle this issue that isn't being done at the moment?
Again, I'm going to ask colleagues. Francois?
I think one of the important issues, as the Governor alluded earlier, is that in the context of the wage settlements, that cognizance needs to be taken of the inflation target, which is 3 to 6%. Secondly, I think one of the elements which has been underplayed in much of the public discourse regarding these settlements, of course, refers to the matter of productivity, because ultimately what is a very important factor is, of course, the change in unit labor cost of production. So I think part of these discussions needs to focus on that, because it's imperative that we do not lose the competitive advantage that comes with a weakened exchange rate, and that we erode the benefits of that, and that we fall into this trap of a wage inflation spiral. So I think, and what is important is that I think all parties must maintain cool and calm and be collected and try and be productive and sensible in this process, so that we don't also cause long-term damage to the economy. We've seen the reaction to the markets, to the most recent developments. So I think all parties need to be responsible and take cognizance of the wider impact that some of these actions have on the broader economy.
Anyone else? Any more questions? Yolanda, anything from you? Renee?
Sorry, Governor, I actually kind of want to follow up on what I asked earlier about the financing of the current account deficit. I specifically want to know about the quality of inflows. I understand that at the moment we are still, standing at positives in terms of bonds and equities, but both those categories can be easily reversed. Is the committee worried about the fact that we don't get more permanent or more long-term kind of inflows?
I think in that respect, it's not a concern that the committee has. Of course, given the profile of the financing in South Africa's case, yes, it would be better if one had a better mix and had FDI flows steady forming part of that component. But the experience we've had in South Africa is that we have traditionally a finance account deficit through portfolio flows which have tended to be relatively stable. And I think it is important also to add that not all the flows that we've managed to attract have been attracted merely as a result of investors chasing yield and looking at interest rate differentials, but there's also been a structural shift and exposure to this economy, partly also informed by things such as the inclusion of South Africa into international government bond indices. So an element of those flows are likely not to react to changes in monetary policy stance in advanced economies, but have come into this economy as by way of a structural exposure to this economy. So there will be an element of those flows that, of course, will react to the changing financial markets environment, but we are comfortable that there is an element in there that is likely to stick. And as I said, that has been traditionally the financing, and which has tended to be quite stable.
Any other questions? Colleagues, anyone would like to add anything? Thank you all very much indeed. Thank you for joining us today, and we will see you next time.